Hello, everybody. Hi, dear Etorians. This is PC here from Global Alpha Search. I'm coming back to you with the usual monthly update for the month of April 2022, which turned out to be one of the worst Aprils in history. It was actually the worst month for equities since October 2008, sorry. So actually since Lehman induced recession that we faced back in 2008. So pretty much no places to hide. Equities were slammed. Bonds were down. Cash turned out to be the best asset to hold. So at least you lost against inflation holding cash this month, but you did not lose as all the other assets did. So I will get to all the details just throughout my presentation. Let me just present you my screen. All right, so April, worst month since October 2008. That's what I have already mentioned. Let's move on to the portfolio analysis. April for stocks is usually a good month. As you see here, on average, April yields 1.5% gain, which is the second best monthly gain after July statistically. Once it's up on month in April, it yields 4.4%. Once it's down, it yields 3.8% on average. That's the usual statistics for April, but this year it looks like this: S&P 500 down 11%, Nasdaq 100 down almost 16%, Russell 2000, the small cap index, down almost 13%. So it's an absolute outlier month this month, but given the kind of conditions that we're facing, there's nothing else we can do about it, really. Our portfolio was also down almost 15%. I will explain you the details of our return in just a little sec. So we did worse than the S&P, much worse than our synthetic internal benchmark. I will explain it in a second as well, for the reasons that I will provide too. On a year-to-date basis, though, we still outperform all the equity indices. So the portfolio as of yesterday is down 2% for the year. So on a relative basis to equities, we still outperform heavily. S&P is down 13%, Nasdaq is down 21%. So actually in a technical bear market already, S&P still in a correction, Russell still in a correction as well. Our portfolio, as I said, marginally down for the year now. Portfolio overview. Synthetic internal benchmark down 8.2% this month. So given the fact that we were down 14.9%, we underperformed our synthetic internal benchmarks. The reasoning behind it will be explained in a little moment. S&P and Nasdaq down 11 and 16% respectively. Equity allocation as of end of month in terms of pure stocks is 52%, and with equity ETFs represented by the SPLV, the low volatility ETF, is roughly 60% right now. Cash is 26%. In terms of exposure, stocks on aggregate basis constitute 83% right now, but this is obviously because of the fact that we have a big cash balance and no leverage as of end of month. So equity allocation is a better measure right now. Long treasury is fully neutralized, just 1% exposure, and commodities in general, 12% exposure, constituting of gold and uranium miners ETF. Which I treat as a rather commodity exposure rather than equity exposure. Crypto exposure, slightly less than 3% in terms of allocation, is like 1%, I think. It's a long-term Ethereum holding, which I do not plan to either sell nor add to. In terms of risk, our average was 4 for the month, and in times of highest volatility, like for instance, yesterday, the last Friday of the month, we possibly had a max risk of 6, given the gearing that we applied to the portfolio. Reshuffles over the month were as follows. In the core equity holdings were concentrated again towards value and the low volatility equities. So SPLV ETF plus names like Coca-Cola, Micron I have added into the end of the month. It's trading at absolutely laughable PEs right now, and it's a stable value stock, even though it's a semiconductor name. So I feel very comfortable being long this one. We also have pretty okay holdings in Porsche and Volkswagen as far as the European holdings are concerned. Both stocks trade extremely low valuations as well. Obviously, right now the Eurozone is facing the risk of recession given the fact that we have all the negative results of the world facing right now, but in a long-term perspective, these names trade at extremely appealing valuations. Range bound to higher, that was the basic scenario for the month of April. As it turned out, it was exactly the opposite. So this was unprofitable for me, for my portfolio throughout this month. And the fact that the cash buffer of 15 to 25% was used for swing trading was also unprofitable. Obviously, all resulting from the fact that I had bad assumptions for this month. And the assumptions were bad because of what happened throughout the month, really. And I mean, the Fed pivot towards hawkish in March to extreme hawkish in April. I will come back to that in just a little while. The tilt duration was mostly kept zeroed, and the exposure to gold was lower than last month because I have closed positions in the long gold CFDs and kept the GLD ETF only. Here I split the active performance, active return for April and year to date. April is highlighted in red, obviously because of the fact that we underperformed 6.7 percentage points versus the synthetic benchmark and 4 percentage points versus the S&P. And the reasons for the underperformance were a bad positioning into April, which I have already mentioned, and the wrong basic scenario, which was range bound to higher in general. Gearing was the major reason for the underperformance and added additional negative 6-7 percentage points especially on 2-3 outlier days, like the day like last Friday, right? Basically, the last Friday of April, when the market was between 4 to 5%, and our portfolio also lost 5%. Because of gearing, right? Lack of hedging. Hedging was basically what we implemented throughout January, February, and March. It was mostly not implemented in April, and obviously that as an effect caused the portfolio to go down as the equities were going down as well, instead of neutralizing the long equity holdings. On a year-to-date basis, the portfolio still looks much better. On a relative basis, we outperformed the synthetic benchmark by 10 percentage points and 11 percentage points in terms of the S&P 500. The reasons for that was positioning in the first quarter, hedging of both equities and the treasuries longs, and the equity allocation that I lowered over the course of December and January. Major drivers in April were as follows. The month that is usually second best month, which I have already showed you, this time was an absolute massacre. There was no place to hide. Equities were down, they were slammed. Bonds were down as well. Gold even was down. So the best asset to hold was actually cash. You lost against inflation, but much less than holding any other assets. Dollar was the big winner. That results obviously from the this differentiation of Fed policies versus ECB and the BOJ policies. ECB and BOJ are still much more dovish. ECB is facing a double whammy, actually, where they see high risk of a recession as a result of the war in the Eurozone, and yet rising inflation. So the best thing that they can do right now is basically to sit back and see what's going to happen in terms of geopolitics and what impact it will have on the macroeconomic conditions in Europe. Fed acting as Volcker-like, so pretty much just Chair Volcker did in the 1980s, fighting inflation. Mr. Powell is looking to tame inflation at all costs, underlying all costs, and hence killing risk asset sentiment to historical lows. The war continues with it still has effect mainly via supply shocks in the oil and gas markets, given the fact that Russia is one of the world's major supplier of both of those commodities. First quarter 2022 was a negative GDP quarter, down 1.4% quarter on quarter. So obviously the fears of the recession being called official in US are rising. Let's just remind that by definition in US, a recession is called a period where there are 2 consecutive quarters of negative GDP growth. High valued growth stocks were the major drag lower in April. Valuation compression was extreme. Many of those names are down between 70 to 90% from their tops last year. Funds like the ARK innovation funds by Katie Woods are absolutely devastated these days. In April, obviously, we had another story coming from China, which were namely the COVID-related shutdowns. This spurs additional worries as to the growth going forward. The major saying which says don't fight the Fed, as it turned out, works both ways. There's no Fed puts, or there's no Fed put this time around anymore for equities, and just as it works not to fight the Fed on the upside, on the downside it works the same. The Fed wants to see something broken. It's either going to be equities or bonds, or maybe even both, until they make a pivot towards more dovish policy again. Quick overview of the Fed. I have promised this is the comparison of the message we were getting from the Fed in March versus April. So in March, the situation was still pretty stable. We had a $9 trillion balance sheet by the Fed. We had a clear message of 1 rate hike in March, which happened, and another 6 hikes due in 2022. So the trajectory was pretty much outlined pretty clearly, and the markets felt okay with this, right? The balance sheet runoff was confirmed to start later this year. In general, there were conditions for more volatility, but given the fact that most of the Fed trajectory was kind of priced in, the markets felt comfortable with it. But throughout April, we saw an extreme pivot from the Fed, a slew of ultra hawkish Fed talk over the month. Mr. Powell obviously standing at the front of it, saying that they need to tame inflation at all costs. So right now, given the fact that the labor market is very good conditions, in fighting inflation becomes the one and only mandate of the Fed. As you remember, the last reading was 8.5%. In terms of CPI, which is basically the highest reading in 40 years. So there's been a massive parallel shift higher in the yield curve, over 40%, over the 40 basis points, sorry, if I'm not mistaken. So these are massive moves, and right now the Fed is already putting forward 250 basis points hikes priced for May and June, and possibly more going forward into the year, plus a risk of one or more 75 basis points hike. So what they're planning to do right now is get to the neutral rate, which, as they deem, is between 2.5% to 3% in terms of Fed funds rates as soon as possible, and then kind of take a wait and see mode and see whether this will start impacting inflation. As you see right now, it's already starting to impact demand, aggregate demand, in terms of consumer, in terms of real estate, in terms of business. All the, or most of the readings from those spaces are worsening quite dramatically even on a month-to-month basis right now. So it will most possibly start having impact on inflation. But remember that unfortunately right now, in the shortest term, the impact on inflation is the biggest from supply side, not from demand side, right? It's the commodities that basically make the difference right now. But in the longer term, what the Fed seems to be willing to do is basically to tame demand to such a low level that will start impacting demand for commodities as well, and will have some kind of a negative impact on inflation, or a positive impact in terms of making the price growth dynamics subside. No Fed put anymore for the markets. This is pretty clear right now after a month for equities that were down between 10 to 15%, right? Quick look at the inflation tendencies. 15 out of 18 major inflation readings right now for the US market are higher than the last reading. In March, it was 14 out of 18, right? So the situation got even worse right now. Now, there's a lot of talk in terms of whether inflation is at peak or not. Some say yes, some say no. I think the best thing to do right now is just wait and see. There's just too many things that are not really foreseeable at this point of time in terms of geopolitics and stuff like this. So wait and see mode is the best thing you can do right now, I think. The macro heat map, inflation, right? It's highlighted here, still the absolute number one issue in all the Western countries. China and Japan are in a better situation, so they are in a better position. But not only US but also Euro area is facing an extreme level of inflation not seen in many years. So Fed is most hawkish since Volcker, whilst ECB, for the reasons I have already mentioned, is much more dovish. BOJ is much more dovish as well. So there is this discrepancy between monetary policies all over the world, and this results also in a massive surge in the dollar. A slowdown is now getting more and more clear across the board. Consumer, as I have mentioned, PMIs, ISMs, real estate, mortgage rates, they're all showing signs of deterioration, further deterioration, and many are at extreme low levels, especially in terms of consumer sentiment. There are serious recession fears. It's not a basic scenario for this year yet, but it might just as well change over the course of the next couple of weeks, dependent on whether the Fed decides to change their view or not. And now the big question, obviously, is how low will equities go before the Fed breaks? We're down in a bear market in terms of tech stocks already, and we're deep in the correction territory for the S&P 500 already. So there is a level somewhere there, possibly another 4-5% lower on the S&P, where we should be expecting Fed to make a pivot in terms of their monetary policy. Over the course of May or June, maybe. All will depend on market conditions. Commodities, quick look at the commodities. As you see here, crude oil April versus March, higher Brent. April versus March, higher nat gas. April versus March, much higher gasoline, much higher heating oil, much higher coal, much higher, right? So the supply shocks are still there. The commodities are still in a geometrical surge higher, and until that does not change, taming inflation will be tough in general. Let's move on. Forecasts. We're still in the boom phase. We're in an extreme phase of taming demand by the Fed, which we already know. After April, coincident indicators will most possibly start worsening. Industrial production has already showed signs of deterioration, and the delta, so the difference between the S&P year-on-year change and the short-term unemployment rate is also getting worse, given the fact that the S&P is just plunging, right? Not planning to fight the Fed on the way down anymore. Basically, that's what we have learned over April. We had bad assumptions, and the market and the Fed has showed us very clearly that there is no Fed put at the moment, at least not for now. And over the course of May and going forward, until I hear a clear message from the Fed that they do make a more dovish pivot, I do not plan to fight against it, and rather concentrate on protecting the year-to-date returns, which are still pretty good on a relative terms compared to equities in general and our synthetic internal benchmarks. Meanwhile, markets are in the midst of a possibly minus 20% correction from the tops, so which would lead us to levels between 3850 to 4000 on the S&P. We're not that far away from there, but let me just show you one more graph to kind of explain why I think extreme caution is still the best attitude, and it's highly recommended. Here you see a long-term, not long-term, let's say a 10-year graph of the S&P year-on-year percent changes. And as you see here, in normal conditions, those year-on-year changes are above 10%, right? And that's where we have expansion and the market is rising in general. And it's always okay. Those kind of returns can happen, obviously, in times when we go from recession into recovery. And then, given the fact that usually the markets are very oversold, over the next year, the returns are reaching extreme highs, right? But on an aggregate basis, in a normal expansion phase, those returns on a year-on-year basis are between 10 to, let's say, 30%. But let's just see what happens here. This is the so-called zone of death. So it's between plus 10% from last year to minus 10% from last year. Once the S&P enters the zone, the dynamics change very dramatically, and usually it drops very quickly from plus 10% year on year to 0 to even minus 10% year on year. That's exactly what happened in 2016. That's exactly what happened in 2019. And obviously during the COVID recession. Right now, we have just entered this zone of death as well. Let's say at the start of April. I mean, we kind of entered it for a little bit in February, I think, and then came back higher. But now we definitely did enter the zone of death, and we're at I think now minus 2% in terms of this year-on-year percent dynamic. So we might just as well see an acceleration of this move lower in the coming weeks, which could lead us to the minus 20% correction top to bottom to levels between below 4,000 points on the S&P 500. 3850 is exactly where the minus 20% from the last top would basically end up. Please remember that the Fed does not want a recession right now, and that what they do is they plan to follow the 1994 policies when they finished with a soft landing. So I think I personally think that we are closer to a moment when the Fed will make a dovish pivot, and everything that is hawkish, at least for now, is priced into those markets right now. So we might just as well get a pretty dynamic fall from here of another couple of percent, and then a pivotal change higher later in the year, possibly in the second half of 2022. That's it from me for this month, guys. I think 95 new copiers this month. Thank you for this. I know it's not an ideal moment. Most of you are down right now, but please do remember that this is a long-term strategy. Copying for at least 1 year is the absolute minimum. I always repeat it. And 1 year is still not long-term. It's not even far from long-term. It's best to copy for 3-5 years or longer for the strategy to basically making its added value into the portfolio's returns. $500 minimum copy. Click copy open trades, right? And please always be patient and resilient through turbulences. This is kind of the best saying you could ever get, given what we saw in April. So all the best for you guys. Let's stay calm and just continue with your strategies. I'll hear you in a month. Thank you very much.